Welcome back, everyone. I'm Raja Khouri, and in this Life Forward short, we're focused on actionable insight that help advisors and investors move confidently forward. Today, we're taking a practical look at the market landscape and the real-world implication on portfolios, retirements, and risk. I am thrilled to welcome back Sadiq Adatia, Chief Investment Officer at BMO Global Asset Management. Sadiq oversees investment strategy across multi-asset portfolios and has guided clients through market cycles with a focus on discipline, diversification, and risk-aware decision-making. Welcome, Sadiq.
Nice to see you.
Nice to see you too. Thanks for joining us. Sadiq, let's start with the pulse. From your vantage point, what's the single most important macro force shaping markets today? And what's not getting enough attention?
Well, it's easy on the macro force that's driving pretty much all the volatility and noise out there is definitely going to be interest rates. What's going on with interest rates is something that everybody's been talking about for the last year. And in an environment where we're seeing a lot of debt out there, we're seeing consumers starting to be a little bit more weaker in terms of their spending, how the interest rate environment plays out is really going to be very important. If we get the continued interest rate cuts in the markets, that will probably give a better positive sentiment and consumers will continue to spend and spur the economy. What's probably not talked about as much, though, is still the Trump uncertainty. We saw that early on, beginning of the year, and everybody talked about it, but everybody's kind of stopped talking about it now, and it's not fully priced into the markets.
Well, how are you reading the rate path, particularly when it comes to the fixed income environment?
Yeah, I would say, given that we're not expecting to see massive amount of rate cuts, I would say the fixed income market is more what I call in a neutral camp. Neither it's going to be excessively strong nor excessively bearish. So probably giving you a healthy return, outpacing cash. But I think the key there is that in the fixed income space alone, I think you still want to own a little bit of credit because the markets are still going to be relatively okay. Economy's still going to do relatively good. So you do want to take credit to pick up a little bit more yield. I don't think you want to go too much into lower quality. And then even though you might get a higher yield out of it, I'm not sure you're getting compensated enough to take on that risk. So keep it simple, keep it with a slightly higher yield, but again, not get too crazy.
Well, equities have been a story of leaders and laggers. Where do you see relative strength emerging?
Yeah, in the equity space, we've seen obviously a lot of strength previously in U.S. equity markets. I would say this is going to be a story of being a bit more globally diversified. So thinking about opportunities outside of just the U.S., though I think the U.S. will still do fine, but things particularly like emerging markets, where I think it's been under-owned, under-invested, but given the situation we've been seeing more recently with the U.S. and China, the tensions seem to be a lot less than they were previously. And therefore, there are opportunities within that space I think people have been forgotten about. If you think about China in particular, that's an economy that's one of the largest economies out there. And not having a proper allocation to that, I think you miss out on a big opportunity in that space. Furthermore, we all know about the Magnificent Seven and the big tech names out there. But people are forgetting there's also big tech names within China as well and within the broader emerging market space. So I think that's another area where you want to be looking at.
Well, let's translate that into a portfolio playbook. For a balanced investor, what are some of the core moves you'd recommend over the next, say, 6 to 12 months?
Well, first is to stay invested in the equity markets. It's easy to look at the markets and say, we've had some great runs, probably want to take off, equity risk. But I don't think there's anything to worry about significantly on the economic front. And therefore, I think you want to remain invested in equities. Equities should still outperform bonds and cash. But at the same time, I think you want to be cognizant about the fact that nothing moves in a straight line. There will be volatility as we saw in November, as we saw in April. So you want to own things like gold. Commodities, I think, can be a good hedge, still participate in the market. And especially if you look at things like currencies, US dollar could weaken a little bit in the first part of the year as we do see some rate cuts happening. And therefore, gold would be a good hedge against that as well. So things that you want to look at positioning is continue to be overweight equities, hold minimal amount of cash, hedging with things like gold along the way, and then diversifying more broadly as well.
Well, let's talk about risk. What do you think is the top risk that investors underestimate, and how do you hedge against that?
Yeah, so the first one I think is still the Trump uncertainty. You don't know what you know, but there's something that's going to happen that's going to be unplanned. And so in that environment, you do want to have some things in your portfolio that are going to be a little bit more risk-proof, or at least well protected in that side. And I go back to gold as a good example of that. Where you can use option strategies, that's another way to put options to protect against the downside risk in the portfolios as well. But you do want to have still a balanced portfolio. Owning some bonds help protect against some of that risk as well. And then if I think through, outside of just the traditional risk of, Trump, there's still going to be the situation of, will the AI story continue to evolve and continue to get the right attention? Or will it start to look like people doubting it a bit more, as we saw in November, and markets could pull back quite a bit on it? And again, the Federal Reserve, Bank of Canada, what will they do with interest rates? Will they continue to cut in 2026? And by how much? The more they cut, the more opportunities are for consumers to continue spending. But if you're cutting too much, that likely means there's something wrong with the economy. So it's a nice balancing between the two to figure out where you want to stay invested, where you want to be a little bit cautious. Again, how the economy goes from there.
Well, if we can translate that into what it means for clients nearing retirement, how do you balance income stability and growth in the face of inflation?
Yeah, I think this is where your dividend strategies are important. You want to pick up yields, still want to grow your portfolio. But as you get obviously closer to retirement, your risk tolerance has to drop off a little bit. Now, generally people think about that as, I should go into cash or something a little bit more conservative. That's not the right strategy, because you still want to have, years of growth in your portfolio. And therefore, having a dividend strategy gets you that equity exposure, gets you that yield exposure, but also in a more conservative, higher quality sort of environment. And I think that's kind of the type of strategies you want to look at. And there are other income strategies you might look at within the bond space as well to make sure you continue to get yield to support your expenses, but you can still fight against inflation.
Let's get tactical for a moment. If I'm an advisor seeing my client for this quarter, what are the 3 actions that I should take right now?
Well, the first thing I think is you should walk through them 2025 and say, how did that feel to you? How was your risk tolerance during the environment? Because that's a good way to check to see, was that the right, amount of equity risk, right amount of bonds that you have in your portfolio. The second thing you want to ask when you're looking at things is that, what was your, objectives coming into the year? Has that changed throughout this year as well? Are there new things that have popped up that might change your risk profile along the way outside of just the risk tolerance? And the third is, how conservative you want to be in terms of your cash positioning. We've had a great, few years in the markets. Sitting on cash makes everybody, comfortable, but doesn't really do a lot for your retirement. So again, go back and revisit things where if clients have an excess amount of cash, how do we get that deployed back in the market and have the money working for you?
And how would you frame expectations for clients to be realistic, but yet confident moving forward in the market?
I think you have to be honest and tell people it's been, a great few years for sure in the markets, but definitely markets have done much better than the long-term assumptions would dictate. And therefore, you are due for a bit more volatility and potentially some pullbacks along the way. However, markets should still give you positive returns, or expected to give you positive returns. And so it's important to highlight to people that you're not giving away the returns, but you have to be reasonable about what your expectations are going to be. Markets don't go up every single year. Markets don't go up in a straight line. So you want to make sure you have that exposure in your portfolios, but you don't want to be looking at it every single moment of every single day, because you would get scared and potentially pull out your funds at probably the worst time. And we've seen that time and time again. People have made mistakes by pulling out of the markets and trying to time it. Stay invested. Think about it long term. Don't expect 30, 40% returns every year. We do get them sometimes, and we're fortunate for those. But kind of a more realistic is probably closer to that 8 to 10%.
What's the biggest misconception in the market right now?
Oh, I think it goes back to the fact that markets don't go down. I think people think that, all the noise we saw this year, markets kind of ignored it. But that is not true. The markets did actually take that into consideration, but the underlying fundamentals of the economy were actually still strong, and that overshadowed everything. So people keep forgetting the fact that, markets do react to information, sometimes overreact, sometimes underreact to it, but eventually they do react to it in the right way. It just takes a bit of time.
Is there an area where clients are underallocated?
Yeah, I go back to that emerging markets comment. I think over the last, 4 or 5 years, there's been a lot of money moving out of the emerging market region, partly because there was a worry about the tensions between US and China. And people thought potentially it would be an uninvestable universe to be in. I think now you're seeing a better environment coming through. We're seeing a bit more stability. We're seeing governments step in a little bit more. There are still some risks because it's still an emerging market region. But I think it's an area where you want to start adding some allocations to that emerging market region to, again, help broaden your portfolio and not forget about a market that is actually one of the most fastest growing markets in the world.
No, that's great, Sadiq. I mean, just a couple final maybe questions for me, but what's a principle that you teach any investor?
I think it's just don't try to be too cute about it. Keep it simple and keep investing.
And final word, is there a word that define this particular cycle?
Oh, definitely resilience. I mean, consumers have been resilient, markets have been resilient. I think that's a key word for this year for sure, that we've done well because everybody's been resilient.
Sadiq, thank you for your time and for your insight, particularly on the playbook. Great to see you, and we look forward to seeing you again.
Always a pleasure. Thank you.
Before we wrap up, I want to express a sincere thank you to all of our guests who joined us throughout the year. And of course, I want to thank all of you for being with us each and every month and helping this series grow and evolve. We look forward to bringing you even more insight and conversation in 2026. Happy holidays.